Hey friends, welcome back to the channel. My name is Sanjay and today we're going to talk about property ETFs, specifically ones that are listed here in Australia. Now this is actually quite an interesting topic. I actually had a request from one of my viewers, Michael Papp, and he had this lovely comment. Hello, love your channel. Thank you, Michael. I'd love to see a video on property ETFs like VAP, SLF, DGRE, and I'd like to hear about comparison of the three, or would you have all three in a diversified ETF portfolio? Good question, Michael. I actually added in an extra ETF that we'll also have a look at. But the idea of property ETFs, if you are new to the whole idea of ETFs, is you are basically investing in a collection of companies that have a collection of properties where they're collecting rent. It's actually an incredibly boring line of business. Think about it. They're just collecting rent. And then they use that rent to basically pay off, cover maintenance, maybe buy more properties, but generally then they'll redistribute that income to their shareholders. And if you collect a whole bunch of these companies together, you have an ETF. Property ETFs are quite interesting and exciting because they often have quite high levels of income distribution coming through. Recently, it's dropped down a bit because of COVID, I guess you could say. But some of these, like VAP, had like an income distribution, just the income itself was like 5%. So in this video, we'll go through those four ETFs. We'll do a quick side-by-side comparison. It'll be pretty high level, nothing intense here. It's very casual analytics here in this YouTube channel. We'll have a look at that. We'll also have a look at what it could mean around that second part of Michael's question around what kind of portfolio would you build around it. And I'll obviously give some of my own personalized commentary on this topic. As always, let me throw in a quick disclaimer. This is not investing advice. You should do your own research. Go and look at a Reddit article, go on the Whirlpool forum, go and do something. Don't just make a decision based on what I say. You should also speak to professionals like financial advisors and mainly tax accountants. Always speak to a tax accountant. I feel like most of my issues come from tax. So the four ETFs we'll be looking at are VAP, SLF, MVA, and DJRE. One Vanguard product, a couple of State Street products, and a VanEck product. I did have a look for BetaShares to see if they had anything in this space. They have a managed fund that has a global focus, but I thought we'll stick to ETFs for now. Now, naturally and immediately, you're going to see a lot of overlap here. The first three, VAP, SLF, and MVA, Australian focused, and because in Australia, the reality is we don't have a lot of kind of property focused REITs or REITs in general. You get a lot of overlap. Look at that. Look at the holdings section. Goodman, Accenture, Stockland, Dexus, and Mirvac pretty much appear in all of these. GPT Group pops up, Charter Hall. It's all kind of the same companies in different orders. So I would say initially you really need either a VAP, an SLF, or an MVA. You don't need to split all three of them. And that's kind of going back to Michael's question, I should have a portfolio of all of them. I'd be picking, if I was to do this, I'd be picking just one. And a lot of you know I'm a massive Vanguard fan. It's actually getting a bit dangerous now, how much of a fan I am with Vanguard. It's challenging though because they have good products. And you look at VAP, it's a broad ETF. I like broad ETFs. It's got the lowest fee, it's half one of them, and it's got a lot of money in it, which is a good sign that a lot of people think this is a decent ETF to be investing in, $2 billion against all the others. Obviously, just the fact that it's got a large market cap shouldn't be an indicator that it's a good one. DJRE, which Michael Papp threw in, was a nice little addition because what you're looking at with the DJRE is a global focus. And this one had less than 5% with an Australian focus. Most of the investment was going to US and European kind of areas. So that is an interesting one. But at a 0.5% fee, it's a little bit high, but you're getting a bit of US exposure or getting international exposure, which is actually quite interesting in the property area. So now we look at some of the companies. I'll be honest, I had never heard of these ones. Prologis, Digital Realty, Public Storage. I think they're big in the US, big internationally, but they're not very big in Australia. Now, they did have, within their top 10, I think Goodman Group was in there, which is an indicator that they did have a little bit of exposure to Australia. So Goodman's actually quite big, relatively speaking. But I think it's mainly a US and European focused ETF. Coming to Michael's other question around what would you be looking at if you wanted to do some kind of combined portfolio, I would be probably looking at taking a VAP or an SLF or an MVA, only one of those. Personally, I'd probably go with the VAP, the Vanguard product. Then I'd probably pick up DJRE or some kind of similar global or internationally focused property facing ETF is what I would be looking at, because you don't want to be too Australian on this kind of stuff. You're not sure which way Australia's going to go. You want to have a bit of global exposure. Now, one thing I will call out though with DJRE is because it's investing across multiple current countries, you're going to be dealing with multiple currencies. Now, I didn't do the research on this, but I suspect there would be some element of currency fluctuation you're exposing yourself to, or you're introducing that as a risk. Whereas with the other ones, it's all Australian focused. It's not that big a deal. But with DJRE, because it's going overseas, I imagine there's some element of currency that you'd have to factor in, just to be careful of. The other thing now, to flip it back to the VAP, SLF, and MVA, is they would have a certain level of franking that would come through. This is where the Australian government sort of gives you a bit of credit to avoid you being double taxed. So that's something to be aware of, is VAP, SLF, and MVA would have low levels of franking, but franking nonetheless, whereas DJRE I don't think has any franking. And look, in all honesty, that's it. That's all I got. There's not much more to say on this topic. You've got Australia, you've got global, you pick one for Australia, you pick something for global, you figure out how you want to weight it. You want to have 90% in Australia, 10% in global, 50-50, whatever it is. I mean, you can take a moment to think it through. So what you're really thinking about is, where do I see the commercial real estate market going? That's actually a bloody good question now that I think about it. Where do you see this going? Where do you see retail space going? Where do you see office space going? And do you see it being redistributed or reused in some way? I mean, even the company I work for here in Melbourne, Australia, normally has like 8 levels, let's say, and they're looking at cutting it down to only 3 or 4 levels. So the company that owns the building that we lease is now in a situation where they're going to potentially get less rent from at least us as a person who's leasing it, but maybe they'll find another client to come in and take some of that office space. So these are all things you got to be thinking about. And the best time to invest in this stuff was probably in the middle of COVID. I mean, that was a good time to invest in everything, but that was a real area where people were very concerned, how will office space rebound in this post-COVID environment. So I think that's going to be an interesting one to think about when you're investing in these, because that's essentially what you're investing is that income coming from the retail, the commercial property space. The other thing I'll just quickly call out is some of the companies you're investing in here, you may actually already be invested in through your broader based ETFs like VAS, A200, whatever the iShares product is, all that kind of stuff. So you're not necessarily missing out on investing in these companies. It's just by buying these particular ETFs, you get a more concentrated focus on this. And there's nothing wrong with having a VAS and a VAP together. It's personally fine, but you just got to figure out what balance you want to get. So if you like the video, make sure you like, comment, subscribe. I have other videos on other ETFs where I've done like ETF comparisons like this, and videos on like getting started investing down here. Check out the playlist below. And I'll see you in the next video. Bye for now.